Joining us in studio, I have the pleasure of having Mihir Vora with us, CIO Trust Mutual Fund. Mihir, great having you. First off, Mihir, let's start off with the earnings momentum that we've seen in Q1, because that's really what has stood out for markets, even though markets haven't moved. But the earnings momentum has been resilient, right, for Q1. You expect this to sustain, or do you believe this is Q1 with some specific sectors really moving the earnings needle, if I can call it that?
Sure. Good morning. Thanks for having me. I think the June quarter numbers overall, as you mentioned, have surprised positively, actually. We were expecting some kind of margin pressure because of the Middle East crisis in terms of raw materials, etc. But companies seem to have done a good job in little bit of price increase and cost savings on some of the items and maintained margins, and in some cases even expanded margins. So if you look at the earnings surprises, there have been more positive surprises than negative. Whether this sustains into the third quarter or fourth quarter, we'll have to really see, because the uncertainties still remain, and there is only so much that companies can do beyond a point, And we also must keep into mind that the El Nino phenomenon is still lingering around. So whether that impacts rural and urban demand or not, we'll have to see. If demand sustains, as so far it has been, then I think we should be fine. But if there is some faltering in demand, then that pricing pressure element might come into the picture. So I think I would say I'm cautiously optimistic on the next quarter.
And Mihir, hi, morning. How does one look at picking stocks or sectors for longer term value returns in a market like this? Because like you mentioned, there are so many uncontrollable factors at play right now. How do you spot value in the market? Sure.
So if you talk about long term, then there's no problem.
Sure.
Right? Because all the factors that we just discussed, margin pressures, that are short term in nature. In the long term, good companies will be able to manage. If your product is good, if you are efficient in costs, then in the long term, you are a winner in any case. So I don't think it matters too much in the long term. What we were discussing is more in the shorter term. In the long term, what matters basically is three things, I would say. One is, what is the moat that you have as a company? Whether it's your intangibles, your technological edge, cost efficiencies, brand equity, many things like, even, for example, IPR, intellectual property. Those things matter in the longer term. Second is whether you have a tailwind in terms of sector or economic tailwind for you. So that's what we call mega trends, right? So, like demographics, rising income levels. Those are going to help some companies in a host of fashion. And third, most importantly, if you look at the long term, ultimately what matters is the management and the promoters, right? So we have a framework which is called LIM, Leadership, Intangibles and Megatrends. So if these three things come together, then we have a winner. And then these short-term things don't matter.
Where are those? Where is there a confluence of those at this point of time in Indian markets specifically?
Yeah, so the broader markets are very exciting, I must say. If you look at the large cap indices, there's limited action, I would say, happening there. But all the innovation and the so-called school stuff is happening in the smaller companies. A lot of action in, I would say, three areas. In fact, we are structurally positive on three themes, essentially.
Sure.
The first theme is linked to rising income levels and rising savings. The second theme is linked to physical asset creation. And third theme is basically all the new age business models. So these, themes have sub-themes within that. So for example, if we talk about the first one, which is rising savings and income levels, everything premium will grow faster. Whether it's goods or services, they will grow faster. So in premium services, you may have stuff like airlines, hotels, eating out. Premium bikes versus entry-level bikes, premium will grow faster. Liquor consumption, gems and jewelry, watches, movies. So all those discretionary consumptions which are higher ticket in size will grow faster. Then within the same financialisation savings theme, income levels theme is the capital markets theme. So broking, wealth management, asset management, insurance, exchanges, those things will grow faster because savings pool is growing faster. So while we are still positive on banks and NBFCs, this segment probably will go faster because we are talking about a mega trend.
Sure.
Right? Then the physical asset layer is something that is very close to our heart. We are always typically positive on industrials, capital goods, construction, and within that sub-segments like infrastructure, real estate, within that sub-segments like defense, power T&D, data centers. Essentially, India is a physical asset starved country. We will be in short supply of everything if we are going to grow at 6 to 7%. So those segments will grow significantly faster. both with private sector support and government support. And we have seen that in sector after sector. Government is encouraging manufacturing. We are seeing a lot of action in precision engineering, all those themes. And the new age companies, anyway, we like the business models. They typically address a large TAM, starting with a disruptive concept, and they keep on growing for very long periods of time. So those pockets doesn't matter. Iran war, this, that.
Sure.
In the short term, this is fine. In long term, all these will be winners.
But out of all of these, where does the risk reward look the best, at least at this juncture? Where is it? Because the re-rating will happen where markets are not pricing the kind of growth that some of these companies could pose. And a lot of the themes you speak about, at least a couple of years of growth is already priced in. So tell us, where is their value?
So what we do is we don't look at re-rating as the upside.
Okay.
Okay. We want to buy stocks at reasonable so-called valuations.
Fair.
So in our portfolios, what we look for is the sheer strength or the sheer rate of earnings growth should be enough to give you good returns. We're not betting on a PE increase so far, so to say. So for most of our portfolios, our earnings growth probably is almost 1.5 to 2 times that of the market.
Right.
Our PE may be 1.2 times that of the market. So on a peg-adjusted basis, our portfolios are actually more reasonable because we are looking at higher growth at a little higher valuation. So when you say, some of the PEs look expensive, I think that's what you're saying. It's basically in these segments where the market is now pricing in long path of growth.
Yes.
Right? And that's what is the debate. Whether a stock trading at 40 times earnings for FY28, what is the long-term growth rate that the stock price is imputing today, right? Because if you look at the next 2 to 5 years of growth, it won't explain more than 10 to 20% of the stock price.
Correct.
So 80% of the stock price is determined by what the market is imputing as the longer-term growth rate of that stock. And that's the whole, fun of buying long-term growth stories. Market might be saying that this stock can grow at 14% for 10, 15, 20 years. But if in our view it's more like 17 to 20%, then there's a big valuation differential. So even a 40p might not be expensive. That's the way to look at it.
So where's that pocket?
So if you look at our portfolios, we are quite positive on all the themes that we mentioned: CDMO, auto ancillaries, defense, capital goods, machine tools. Those kind of names, I think we are just beginning. And the whole ecosystem that is being created by aerospace, defense, electronic manufacturing is spawning many sub-industries, and that's where we are focusing on.
But Mihir, you also spoke of disruption, and that brings to mind artificial intelligence and IT. How are you looking at IT? How are you placed? Would you be constructive, given that the Indian IT services are trying to adopt to the changing landscape on AI, or do you believe that there is still much work that needs to be done?
I think IT companies in their current business model have become more or less single-digit growth companies. Especially, we're talking about the large ones. We have a couple of names in the mid-cap space which are still growing faster because of the niche and the lower base, etc. But the sector, the pure IT services sector as a whole has become a single-digit growth sector. They will need to do something different apart from buybacks to accelerate growth. Otherwise, in the current situation, it looks like they'll have to do a lot more things just to stay in the same place. So it's like a treadmill. So on one hand, you can say that AI will improve productivity of the existing workforce. But on the other hand, you might actually see demand destruction also from your global clients. So it's kind of, running to stay in the same place.
And in terms of larger players who are struggling to move ahead, how are you looking at some of the marquee FMCG staple names?
So FMCG, we are more or less, underweight on all the time.
Okay.
Right? Because it doesn't gel with our growth theme of mega trends, and because these are good companies, good ROC, high cash flow, etc., ROE, etc., but low growth, right? Because most of the large FMCG companies are in categories which are already quite well penetrated. So soaps, shampoos, toothpaste, all those things are penetrated even in the rural markets. So and the only growth you're getting is from a little bit of volume and a little bit of premiumization. So can a category like this, like soap or detergents, grow at 15%? I don't think so.
Okay.
Right? And when there are so many other exciting ideas out there, why go into that?
So you are also looking at premiumization as a theme. So within consumption, how would you place premiumization?
So as I mentioned, some of the categories are going faster. Liquor, gems and jewelry.
Okay.
Then you have retailing, different models of retailing. First, originally, if you see the discount models came into the picture, they grew fast. But now we have mid to high-end segments also coming up in retailing.
Yes.
We've seen a cyclical downturn in, say, the multiplex business. But that also might, I think that OTT threat is more or less done. Everybody who needs to have OTT is done. But now people again want to go out and eat popcorn.
Right.
No, absolutely. I wonder how, looking at some of the niche pockets and faster growing as well, cables and wires to some extent with the whole AI theme that ties up. Cooling products, that's the other one with the AI theme that ties up. Is there something structurally different that you're seeing in any of these pockets versus what we've seen maybe last 2 to 3 years, which allows you the comfort to give them the multiples that they currently command?
The key difference that has happened is all these names that you mentioned, say transformers or cable and wires and cooling systems, etc. They used to grow very well. Of course, they were growing very well due to domestic demand. But now with the explosion in global data center and AI compute requirements, exports have opened up in a big way. So a lot of these companies have actually grown multifold because of exports. And the order book is growing multifold in exports. So that is the new thing that has happened in the last 2 to 3 years. This AI demand for power is actually opening up or rather taking up any spare capacity anywhere in the world that is there in these products.
Also, from a top-down perspective, has return expectations from the Indian market changed materially, especially post the 22-23 era, 2022-23, after the COVID rally? Would you say that has happened on ground? Because you've got obviously a very good understanding of how this plays out. You believe return expectations should be calibrated lower, just given everything that's playing out?
See, the problem is that we end up looking at the Nifty 50, right?
That's true.
But the fun is in the broader market.
Sure.
Right. So we really need to probably change our lens of looking at the market because the Nifty 50 is predominantly now into financial services. The largest weight is financial services, then IT services, FMCG, which are no longer the highest growth sectors. So probably if you want to get a better feel of the economy, we should look at the NSE 500 or the mid cap and small cap indices for higher growth. Nifty 50 will probably give you GDP plus, nominal GDP plus, so 11 to 13% kind of a number in the long term. But I think the higher growth stock picking opportunities are there in the mid and small cap space.
Right. Mihir, you've termed a certain basket of stocks as gorilla stocks. Talk to us about the terminology behind it. Why gorilla? What's the outlook on some of these names?
Sure. So that's a gorilla is a representation of our core investment philosophy,
Okay.
Which is growth at reasonable valuations. But the way we look at valuations is through the lens of terminal value, right? Since we don't have much time, in very short, I would say that we just discussed that for some of the high growth stocks and sectors, what matters is the length of the growth runway, right? It's less important whether the stock is growing at 30-40% for the next 2 to 3 years, but it's more important to figure out whether this stock can grow at 15 to 20% for 15-20 years. Because in high growth stocks and sectors where you or the market starts believing that the growth runway is very long, today's market cap, 80% of it will be explained only by the longer term profits. You can't, even if you get the short term projections right, you'll not be able to get comfortable on valuations, right? So this terminal value is the value of the profits beyond the first few years, which is what you need to take a call on the long term growth rate. So the reason why we call such stocks gorilla stocks, basically they are stocks with high terminal value, where the market assumes that the long term growth rate of this stock is say 12%, right? Which is what the Nifty has done. But if we believe as a fund house that the industry or the stock has a potential to grow at 15 to 20% for 20 years, then the terminal value is 2 to 3 to 4 times more than what the market is thinking. And that's where the difference in perception and that's where our view comes from. So we call them gorillas because such stocks are rare to find. Such stocks become large and dominant in their field. And most importantly, such stocks have the longest life of growth. So gorillas are rare to find. They become large and dominant in their field. And they have the longest life amongst all the monkeys. So that's why we call them gorilla stocks.
Yeah. So would you say that prioritizing the growth runway that we are forecasting for a company right now, I mean, that would take the upper hand over the valuations at
the length of the growth path?
The length of the growth path.
Absolutely.
Mihir, curious to know, you spoke about IT, but the other pocket is banks. And that's one of the reasons why the Nifty has underperformed, right? Now, when you're looking at banks, they're trading at maybe 50-60% discount to their traditional valuations. 3.5 times book has become 1.7 on the largest private sector bank. Even the second largest also trading at a significant discount versus long period averages. What's keeping you away from banks? At least I'm assuming it's because you haven't mentioned banks, it's keeping you away. But give us a sense.
No, see, we are positive on banks.
Okay.
They offer when you talk about risk return or valuation versus growth equation, they offer a good risk return equation. It's just that we have other segments which are growing even faster, so to say, and the valuations are more reasonable. But the issue with banks is 2 or 3 items. One is that we've seen a lot of FIIs selling in the last 2 years, and the largest holding of FIIs was in banks. So that obviously is a technical pressure. Continuous selling by FIIs, and they held some of the largest private sector banks. So huge selling happened in the last couple of years. So that's a liquidity overhang, I would say.
Correct.
That's one. Second is the credit growth has picked up, but does seem to be a scramble for deposits. So while there is some pricing power at the credit growth level, but I think the scramble for deposits is kind of curtailing the growth. So there is a little bit of margin pressure, which was little more than expected in the last couple of quarters. I don't see any other issue. The balance sheets are clean. The credit growth has picked up. Valuations are reasonable. So risk return wise, I think they are in a good spot.
Are you overweight?
One more thing. Public sector banks have given private sector banks a run for the money in terms of competition, right? And over the last 10 years, even PSU banks have upped their IT. Earlier, IT used to be a customer interface. IT used to be a strength of the private sector banks. But now, with commoditization of IT, even public sector banks have upped their game in terms of customer interface. And let's face it, they have more branches in any case.
Right? Yeah, that is also true.
Are you overweight with regard to banks?
No, we are neutral to a little underweight. Within banks and NBFCs, actually, we are more positive on NBFCs.
Got it. Okay, Mihir, pleasure having you here. Thank you so much for coming in and speaking to us.
Thanks for having me.
Thank you so much for your time today.